Welcome to the Biz Coach Show. In every episode, we share information and advice for small business owners, small business leaders, startups, and entrepreneurs preparing to launch their business. Our mission is to give entrepreneurs the edge they need to succeed. If you're in need of business coaching, head over to mybizcoaches.co and book your free coaching consultation today. Our guest today is Scott Gabehart, the Chief Valuation Officer and co-founder of Biz Equity. Scott has nearly 30 years of combined experience as a business broker and business appraiser, and during that time, Scott has evaluated over 3,000 businesses. Scott has a bachelor's in economics and a master's degree from the Thunderbird School of Global Management, where he also served as a faculty member of the Thunderbird MBA program. Additionally, Scott is a certified business appraiser, certified valuation analyst, and business certified appraiser, and the co-founder of the Business Valuation Institute. Learn more at bizequity.com.
Awesome. Well, welcome, everybody. Great to have you here. Scott, excellent to meet you. Great to have you on the show. And Jim, as always, thanks for joining us. We're excited to have you back for the first time in a while. So we'll see how the show goes today. Excited to hear more about Biz Equity, Scott. So can you take a minute and just, Jim, actually tell us about how you and Scott first met?
Well, I was looking around for some business valuation tools because we're starting to work with so many businesses that have that issue, and I stumbled on it on LinkedIn and looked at the opportunity online and really liked what I saw. And I thought, after I talked to their organization about the product and how we might be able to use it, and then it just came to me, boy, wouldn't it be great to share this story with our audience, because it's a topic that every business owner needs to consider, whether they're thinking about selling their business or not. It really doesn't matter. Evaluation is something that should be done on a regular basis, and that's why we're so happy to have you here, Scott.
Absolutely.
Oh, I'm very happy to be here, and I look forward to sharing some valuation insights to you and the audience.
Well, that's great. Well, wonderful.
So, Scott, why don't you tell us a little bit about your journey, how you got to here?
Sure. Well, I think in many ways I had the perfect background for becoming a certified business appraiser, and what I mean by that is that my prior work experience was very general in nature, and that included work as a corporate auditor for Motorola and Shearing Plow in Asia and Europe, and then eventually teaching economics full-time for 4 years. Obviously, understanding the economy is central to any qualified or quality business valuation. So after my stint teaching full-time, I went to work as a business broker and eventually middle market specialist for VR M&A, and that there truly is no better place to learn about valuation in the real world than to be in the middle of deals for all types of companies, different sizes, et cetera. From there, I obtained my first certification to do business appraisals in the year 2000. And over the next 25 years, I've done literally thousands of business valuations of different types and sizes. So with that as my background, and included in that background are a couple of books that you can see on this slide. The Upstart Guide to Buying, Valuing, and Selling Your Business, and the Business Valuation book. Based on those publications, around 2011, Mike Carter, who is the primary founder and impetus for what Biz Equity is today, called me and brought me in to provide assistance and guidance with respect to developing the algorithm. And we did that over the next 5 years. Through 2016, we were basically improving the algorithm and the report. And that's when we started to obtain meaningful capital from outside parties. And we have since then built the tool to what it is today, what ChatGPT considers the largest online business valuation tool in the world. So
Wow.
we like to see that, given where AI is headed. But
Absolutely.
That's impressive.
yeah, well, basically with Mike's leadership, and he's a really incredible CEO. He led us to a focus on business advisors and serving their needs, and just a list of the clients will give you an idea of how much work has gone into this product to make it worthy of their usage. Whether it's Morgan Stanley, TD Bank, there's a long list of these major who's who of financial services companies who have become our clients.
Well, that's wonderful. So today we're going to be going through, just a question and answer with you, and we would like you to just sort of lead our listenership into what's important about evaluating your equity. That's the topic of our discussion today. And I'm going to ask you to give us a quick overview of the program. And so my first question, I'd start with, why is it important for every business owner to understand their valuation?
Well, great question. And before I dive into that, let me just provide the audience with some information. As you see on this particular slide, I'll be making available not only this PowerPoint presentation, but a couple of other major papers. For example, the transaction multiples across value worlds, past, present, and future. That was a comprehensive presentation that I gave to NACVA, the National Association of Certified Valuation Analysts, just a month or two ago.
Wow.
And it's a very in-depth look at how there are all of these different value worlds. And within each value world, the multiples can be dynamically different. And that presentation is a good way for business owners or advisors to get a feel for what's happening in these different value worlds, whether it's angel investors, venture capital, private equity, investment banking, business brokerage, et cetera. So why is it important for biz equity, or why is it important for business owners to understand value? Well, it's pretty straightforward, really. In most cases, a business is the owner's primary financial asset. Most of their wealth is tied up in their business. And the bottom line is that if you don't understand what the factors are that affect the value of your company, you're not going to be in the ideal position to influence that value, to optimize that value. So taking the time, whether you're a business owner or a business advisor, taking the time to learn the basics of business valuation, coupled with using the tool Biz Equity, which will provide you with a 29-page report, 4 estimates of value, 15 different KPIs or key performance indicators. It's time and effort that is well spent. I like to tell advisors that it's really an investment. The time that you invest in learning about valuation will make you a much better advisor and an advisor that the business owner is more likely to turn to. The relevance of business valuation, in my opinion, therefore, is obvious. It's the key asset in most owners' portfolios. and it's worthwhile to take the time to learn about it. This is one of our favorite quotes. Warren Buffett, who everybody knows, has stated, if business schools could offer just one course, it would not be on stock trading, efficient markets, modern portfolio theory. Rather, business schools should be encouraging students to learn the boring but critically important discipline of business valuation. Okay, why? Because it's the heart of investing, risk management, and without it, you are blind. So we obviously like to pull that quote up from time to time, emphasizing the importance of business valuation. And secondarily, it's not just important for purposes of maximizing business value. There are a series of life events where knowing and understanding what the value is can make or break your day. And whether it's raising capital, borrowing money from the bank, granting equity to key employees, buy-sell agreements, gift and estate tax planning, exiting the business, maybe selling to an ESOP, bankruptcy, divorce, all of those are cases or events when having a business valuation is necessary. And again, the more that you are comfortable with understanding and reading valuation reports, the more likely you are to improve whatever outcome is desired in that particular, in any given scenario. And of course, the valuation methods will vary depending on the life cycle of the business and the purpose of the valuation. And these are the value worlds that I was referring to earlier.
Yeah. Well, one thing we see on a regular basis is the sort of the broad spectrum of valuing analysis. What metrics they use, what multiples they use. They're really across the map, not consistent really in most cases. Well, I guess they can be depending on the industry. But when we're talking with a business owner, we find a lot of times that their financials are out of date. So one of the things that we start with is to help them get that cleaned up, because without that, you talk about the scorecard, that is their scorecard. That you can't do evaluation. So, then if someone's talking about maybe selling their business and the valuation shows them, gives them a number that they don't like, it's not high enough, they have to start thinking about, well, I have to either love it and fix it or list it as it is, one of the two. You sort of have that choice at that point.
That's right. But if you don't know, you don't know. And as we'll discuss later, it's not a perfect science by any means.
Right.
Every valuation is ultimately an opinion. But I'll address that a little bit more later.
Yeah, I was just going to add that I think that in the times where I've been involved with owners trying to assess the value, getting them to recognize, and you mentioned it briefly, but the levers that go into that. What are the different things that factor into the valuation, right? Certainly cash flow is a factor of it, or profitability. In our world, we use the term SDE, or seller's discretionary earnings, right? But most of our clients are typically in the small to mid-size range. So, what's interesting to me is, and I didn't play a lot in this space when I was in the wireless industry. We acquired a number of smaller dealers as we grew and added locations that way. But being involved in some of those conversations, how the evaluations were done, it was pretty straightforward. It was like, yeah, you got so many locations, we'll pay you. They're asking for $200,000 per location. We're saying, no, you're going to get 50,000. But how we went into it was not necessarily a traditional P&L, because we as long as we knew the store, the number of traffic counts, the boxes that they were moving in and out of that store, that's how we could quickly identify, based on our level of understanding of our business model, right? And then we could extrapolate onto their data. But when you go from business to business, what's uniquely different is, so many different things, and I'm sure we'll go into this, but whether or not they have a membership model, or at least a recurring revenue model, and different things like that play more of a factor. And I think one of, as Jim alluded to, one of our biggest challenges with owners is getting them to, understand what plays into that, right? And I think that's what one of the great things about your tool, your resources. It helps people really kind of understand what those different levers are that we can pull on. Because if you don't like it today, then we can work with you over a period of time to help improve those certain areas of the business so that we can get that valuation closer to where you'd like it to be, if that's the case.
That's right. That's right.
Yeah.
And all of those industry specific factors that you mentioned briefly, they're essential to a proper and correct valuation. But ultimately, as they correlate to revenues and operating profits and EBITDA and discretionary earnings. So there is a method to the madness, even though valuation is part art, part science. There are generally accepted valuation principles and procedures that help us to stay on the straight and narrow and generate apples to apples types of results.
Well, this is a great segue into my next question, which is what are the primary factors? Why don't you tell us what some of the primary factors that impact business value?
Okay.
What goes into the analytics?
Yeah, great question. And this particular list here is a rundown of the various factors that are included in the Biz Equity tool, which specifically will push the actual final multiple up or down. But in the most general terms, business value is a function of size, profitability, growth, the industry that they're in, even the type of buyer.
Right.
But in general terms, size, profitability, and risk is kind of where it all boils down. We have a size effect. The larger the earnings, the higher the multiple. Profit margins, more profitable, obviously, more valuable. And then the risk associated with those cash flows, those expected future net cash flows. So all of those things are important, but mechanically, as these things exist, they're assessed through these specific factors that we see on the screen here inside of our tool. So these are really the Biz Equity factors. So that means, for example, depending on the NICAS code, the median multiple within our range of multiples could be 3 for one industry and 8 for another. Revenue growth, EBITDA margin, those can dramatically affect the value. And we have a special component to the Biz Equity tool that is specifically geared to value low profit but high growth companies, because one of the most challenging things to do in business valuation is to value a company with no profits. Mm-hmm. They're not making any positive cash flows. You can use revenue multiples, but in the case of companies like those in the SaaS world, the computer subscription-based sales companies, you can utilize the expected long-term revenue growth and EBITDA margin to more accurately derive an estimate of business value. Mm-hmm. And in fact, we do that on our tool. Now, the next series of slides are going to be different snapshots of what multiples are like today or going back as far as 2012 for different types of companies in different segments. So we're starting with a table from DealStats. And DealStats is the premier online transaction database. It's the biggest, 45 to 50,000 transactions going back 30 years or more. They don't always include the older data, but it's a great source for current multiples, whether it's revenue multiples, EBITDA multiples, or discretionary earnings multiples. This particular table is documenting what we call the size effect. As the earnings rise, the multiples rise.
Right.
And in a general sense, it goes like this. Main Street businesses will sell for $2 to 4 times discretionary earnings. Middle market companies will sell from 4 to 6, even 8 or higher times discretionary earnings. And then the biggest companies of all, the publicly traded companies, are selling for 24, 25 times after-tax profits. Higher earnings, higher profits. And in this particular view of the world, you can see that the companies that sold for more than 10 million had a median EBITDA multiple of 9 times in 22, versus those less than a million coming in at under 3 times EBITDA. So
I imagine growth trends have a big factor in that as well. Looking year to year, looking to see if the numbers are going this way.
Yes, there's no question that the deal stats transaction multiples follow the business cycle.
Okay.
And in fact, I like to say that the primary reason why multiples change from year to year within a given industry is that the revenues and profits for those firms in a recovery are rising.
Mm-hmm.
And the size effect kicks in.
Yeah.
So it's not that they're all of a sudden inherently worth so much more. They are, but it's primarily a function of that size effect.
Right.
And if you go back and trace deal stats multiples over the course of the business cycle, there is a definite correlation. Recoveries, higher revenues, higher profits, higher multiples, and then vice versa on the way down.
Well, I know on Wall Street, they value companies on a PE basis, which is really a metric to growth, in effect, growth expectations. That's why companies that in the technology space trade with high PEs, because the expected growth is so high.
Yeah, exactly. And now that kind of brings up the point of 2 general ways to value a company. And here we're talking mostly about owner-operated private businesses. You can either use a multiple against historical metrics, and take into account expected future growth. Or you can just rely on a discounted cash flow model where you're actually projecting those future cash flows and that growth and capturing it that way. But this next table will demonstrate that the average EBITDA multiple is kind of back to where it was pre-COVID. So, and again, remember, these are smaller and middle market companies, and to be fair, even lower middle market companies.
Main Street.
Yeah. So there's another database called BizComps, which is truly just Main Street, but Deal Stats has bifurcated their focus and is spending a great deal of time gathering these middle market transactions as well. And this is the combination of those two. But you can see that for the private companies, the multiples fell significantly in 21 and 22, as they did for the largest public companies. But one of the interesting discoveries of late that I opine on in my NACFA presentation is the strength of the middle market. The middle market companies have fared on average much better than the smaller Main Street and the larger publicly traded companies.
Interesting.
Now,
Scott,
yes,
Scott,
sir.
I got a quick question for you on that
Okay.
last slide. Just out of curiosity, because I'm kind of a numbers geek. I'm looking at that jump in Q2 2018 from 3.5 to 5.0.
Yeah.
Are you familiar with any particular reason why there was such a significant lift at that particular time?
That's a good question. That would have been midway through the Trump administration, and earnings and profits and employment were all faring well, but a specific reason for that kind of a jump, I don't have a real good answer off the top of my head. But you do bring me to an important consideration, and that is the number of transactions that go into calculating any given statistic in a
Right.
database like Deal Stats.
Absolutely.
You know, there's always a potential for statistical anomalies and quirks, but yeah, that's a good question, and I hadn't really thought about it. But what is clear is that it went down consistently over
shortly
the next
thereafter.
4 or 5
Right.
years.
Yeah.
Yeah. So this one just quickly reveals the diversity of multiples depending on the industry. So again, EBITDA multiples and information or computer companies are at the top of the heap. And at the bottom, generally, you'll find retail and accommodation and food service, restaurants.
Right.
And
Low margin
that's
businesses. Yeah.
just kind of the way it is. All right. Now, this is an interesting slide. And I don't think this includes my updated slide. But what you can see here is a chart presented by GF Data. And GF Data is probably the premier provider of middle market transaction multiples within a private equity realm. So they specifically are gathering this data from private equity firms across the country. And one of the interesting things that they've discovered is this tiering of the market, or a premium for quality. And another term that's used is a flight to quality. You know, we get into the turmoil of COVID and now inflation and recession thoughts. It's natural that there is a flight to quality. And what we're seeing is, in this case, is that that's exactly what's happened. The average multiples paid for those companies with higher revenue growth, higher EBITDA margins, professional management, et cetera, is anywhere from 15% to 40% for the smaller middle market companies.
Wow.
That's
Now,
pretty big.
Yeah, let me tell you a story that's anecdotal but very powerful. One of our customers is a provider of financing to private equity buyers. And they provided me with a list of transactions and multiples based on what the actual deals were. And they broke out the buyers between private equity, corporate, and financial. And the disparity was humongous. So I was seeing certain veterinary practices selling for 10 to 12 times EBITDA. And similar in other professional services firms. But for that same type of firm, that same segment, the financial buyers, when private equity wasn't involved, they were 3 to 5 times. So huge difference.
Those private equities, I guess, are more equipped to take on more risk.
They're more equipped to take on more risk, and they're more prepared to help support the management to achieve that expected growth over a long period of time. Private equity has basically changed their investment paradigm from we want our money back in 3 to 5 years to 8 to 10 years. And that's allowed them to get into virtually every major professional services sector, including wealth advisors.
Yeah.
Interesting.
Roughly half of the wealth advisor transactions in recent memory would have been through private equity players. So
some of those firms can be, they can have 2 or 3 billion under management in some cases, which gives them pretty high number as far as revenue go.
And they're picking the cream of the crop.
Right.
and a good wealth advisor can have an EBITDA margin of 45%.
Right. It's pretty high.
And
Yeah.
you extend that out over 8 to 10 years and grow, and you can see that it's pretty appealing.
Yeah. Well, it's interesting. So when in the last wireless dealer I was with, we were a dealer for T-Mobile, and the company that acquired us had gone out and gotten equity, got an investor.
Yeah.
Because of the deal contingencies with the carrier, the investor couldn't own more than 49%. But they gave a huge cash infusion to them because as the industry had matured, margins had compressed dramatically. And so the real opportunity became to a roll-up strategy, right? So you just start acquiring, right?
Yeah.
And so so what had happened was we were doing our own version of a roll-up strategy, and we got to 140 locations. They were maybe just short of half or double our size. I'm sorry.
Yeah.
And when they acquired us, they pretty significant lift, right? It's about a 30-40% lift, but they did 3 or 4 transactions of similar size between 50 and 100 locations. And they swallowed all of those up, used all that cash that they brought in from the investing group. And, they had to keep the management in. But it was kind of interesting how that played out because they brought a lot of money to the table and they paid way more than I think that we would have considered paying. And when they offered us, and what was interesting is our CEO had been courting that owner for 6 years. And when the guy said the right number, the CEO was like, done.
Yeah.
Where do I sign?
Yeah. There's no question. Private equity has dramatically impacted the M&A marketplace over the last 10 years, really.
Yeah, and playing a bigger role in the Main Street transactions.
I'm sorry, say it again.
And I said, and playing a bigger role in a lot of these Main Street transactions, to your point, going into those, what would traditionally be, a mom and pop operation, and seeing the opportunity similarly to roll up
Roll-ups
with more professional management and expand.
Yeah. Yes, that's right. That's right. Yeah, like restaurants, franchises.
Yep.
And that's just the power of the size effect.
Mm-hmm.
You got 10 small companies that you pay 4 times earnings for. Now all of a sudden, package them together and you sell it for 8 times.
Mm-hmm.
Right.
That's where that return is.
Absolutely.
So here's some stats on the growing impact of private equity. 30% of the total M&A market. It depends on who you ask and what time frame, but I've seen between 20 and 40 and 50 for certain industries. $11 trillion over the last 10 years. And interestingly, they still have a very large amount of dry powder, money yet to be invested. And of course, given the economic climate, the pace of their activity has slowed, in the last 6 months. So we'll just see how that goes. But 58% of the wealth advisor acquisitions in 21 were PE driven. So underlying any discussion of multiples and what affects the value of companies is the economy. As I mentioned earlier, multiples track with the business cycle, generally speaking, all of the things equal. And where are we now? Well, we're not in a recession, certainly not technically speaking or officially. The economy declined for 2 consecutive quarters in 2020, but since then, it hasn't repeated that pattern. And the NBER, National Bureau of Economic Research, has not opined any kind of a recession. But there are mixed signals. That's all you can say. Is right now we're on the cusp. It could go either way. We might be able to get the soft landing that everybody always hopes for. But if you look at the predictions from prognosticators, it's leaning more so towards the side of recession. Mm-hmm. But currently, GDP growing, equity markets were rising. August was a correction, obviously. Inflation has softened, but it's picked up again.
Yeah.
And there's just more worries about that. Core inflation is above the target. And one thing that doesn't get really enough coverage is this notion of a lag in monetary policy.
Yeah.
12 to 18 months before higher rates have their full impact. So there could be, the worst is yet to come. Credit conditions have definitely tightened. Oil prices have gone up. There's plenty of political uncertainty. So we're on the cusp, but nonetheless, we've seen that deal values are down over the last year or so, but the number of transactions is down less. And basically what that means is that the players are shifting to smaller companies, smaller deals.
Reaching into a different pot. Yep.
And private equity is a big part of that middle market focus.
Back to the economic analysis, it seems like that the main concern, that the only really concern that's left as far as prognosticating that possible recession is the fact that the yield curve is still slightly inverted.
Yes.
I think that's driving, in my opinion, that's driving Fed behavior right now. So I don't know. I'd like your opinion on that.
Well, I agree. We all know that roughly 9 out of the last 10 recessions were associated with an inverted yield curve. And some of these professional prognosticators include that fact in their assessments. PitchBook is still predicting a recession based on their qualitative model, which includes a look at the inverted yield curve. Morningstar expects growth to weaken, but is more optimistic than average. The Congressional Budget Office, economic growth will slow, then pick up in 24. And when they say slow, I saw numbers of GDP growth of 0.6, very, very timid growth. Conference Board, growth will buckle due to declines in consumer spending, compensation, savings, commercial lending, and government spending. In other words, all those things are trending down. So they put the recession odds as greater than a soft landing. And they feel that the Fed is going to raise rates again before we're done. And with inflation ticking up again the last 2 months, that would seem to be more likely than it was 2 months ago.
Yeah.
Now, moving closer to a more positive outlook, which was starting to emerge before the inflation reports. Vistage CFOs, small business owners are divided on the recession versus soft landing, but make the point that it depends on what industry you're in, which is always the case. Now, this last one, I think, was more typical of where we were heading before these inflation reports. The AICPA surveyed executives, and only 16% were expecting a recession this year. But again, that was before the inflation pickup and the now growing potential for higher interest rates.
Well, it's interesting about these talking heads and the supposed experts out there. They all come across with the same message, and it says that we'll have a recession unless we don't.
Yes, or my favorite answer as an economist and as a business appraiser is it depends.
Right.
Yeah.
It depends.
Yeah. That's a great. In 2006, we launched that last wireless company that I referenced a minute ago. And in 2008 and 9, when everybody else was laying off and shutting down and outsizing and downsizing, we were hiring. We were hiring left and right. And we continued to grow. As a matter of fact, we had a unique distinction. We had 140 retail locations and never signed a personal guarantee on any of those leases, because the real estate, commercial real estate for boutique retail, they were hurting. Those small operations were closing down, and we were signing leases left and right as a smaller startup company. I mean, our year one, we only did $1 million in revenue. So we were able to sign all those leases, and over all that time, we never had to sign a personal guarantee. And it's an added benefit when you're a small business owner. It's seldom is the case. But
that's right.
I was making money. I was making twice the kind of money that people that I was familiar with in other spaces for the same kind of work. That because the wireless industry was just killing it at that point.
Yeah. Yeah.
Scott, to keep things moving here, you're doing a great job talking about the primary factors that impact business value. Are you ready to tell us what maybe some of the myths and misconceptions are out there?
Sure. And this is one of my favorite topics. And it all starts with the fact that business valuation is not a hard science like chemistry or physics. It's a soft science, much more like economics.
Yeah.
And the answer often is it depends, as we just discussed. And in reality, as per professional standards, every valuation report is simply it's an opinion.
Right.
It's not the value; it's an opinion of value.
Mm-hmm.
It's based on noble facts and reflects generally accepted valuation principles and procedures. But again, at the end of the day, it's an opinion based on literally layers of assumptions that go into every appraisal. And before I delve more into that, another kind of misunderstanding that's rampant, and I'm sure you've come across it, is that many business owners have heard some kind of rule of thumb,
right,
that they think their business is worth, and that's something you have to be very careful with. Whether it's a rule of thumb that's some multiple of revenue or profits or whatever it is, you have to be very careful, recognizing that there are in fact certain types of businesses where a rule of thumb is critical and essential and pivotal. For example, when I was a business broker, I was selling CPA practices or bookkeeping practices, accounts, and every single one of them knew about and used a rule of thumb of around 100 to 110% of expected collections. That's just what it was. They all knew it. They all used it. It may be 120 or 95, but they all used that rule of thumb many times, irrespective of what profitability was.
Right.
Insurance agencies sell for multiples of billings, and it's an important part of the valuation discussion and conversation. But blindly relying on a rule of thumb is a problem.
Yeah.
And there is no such thing as the value of a business. Okay, why? Well, mainly because there are many different measures of value. There's fair market value, investment value, liquidation value. There's asset sale value, equity value, enterprise value, liquidation value. And as a result, there is just no such thing as the value. It's always dependent on circumstances. However, that said, with respect to the biz equity tool, the two most important measures of value would be the asset sale value and the equity value. And those are very definitional, specific, generally accepted. And for example, an asset sale value is not the value of all the assets. It is specifically the value of the inventory, fixed assets, and all the intangible assets, trade name, goodwill, covenant not to compete, etc. But an asset sale value does not account for cash or receivables or liabilities. That's where the equity value comes into play. And the equity value is equal to the asset sale value plus cash and receivables minus all the liabilities. So there is no such thing as the value, And even if you provided 5 appraisers with the same exact identical pattern of facts, you're going to receive 5 different estimates of the same type, like an asset sale value, that are going to differ. And they're going to differ between, in my example, if the mean was 10 million, it would differ between 9 and 11, or even greater than that. And again, that's just the way it is. That's the nature of the beast. That's the role that assumptions play. They choose different valuation methods to rely on. They weight the results differently, on and on and on. And when interpreting the biz equity estimate, I am confident and proud in saying that 95% of the time, the estimate that we generate will fall in between the range of what you would find if you hired 5 different appraisers. Again, recognizing that there is no such thing as the value of a business.
Right. Well, if you're a Main Street business and you're looking to get a valuation so that you can sell it, at the end of the day, you better be working with a business broker that understands the market, the competition, who's worked with industries just like yours, and it's like in the Phoenix market, for example. Because at the end of the day, it's a business is going to sell for a price that a buyer is going to want to pay.
That's right.
So, it's that you can put any multiple you want on it, but you can have your business listed up there for months and not get a single bite.
That's right.
Because you've priced it too high.
Yes, I absolutely agree. The right business broker is the right way. But as a consumer or a seller, you also want to be careful, not in just hiring the right appraiser, but also recognizing that it's not the law that the commission is 12%. Right. Commissions are negotiable. And the better your business is and the more likely it will sell, the more flexible that commission would be for the business broker.
Right.
So great point as well.
Yeah, exactly.
Just bear that in mind. That's my 2 cents worth there. But the right business broker is wonderful. I mean, they can get you more and literally earn their commission.
Yeah. I mean, if you've got a yogurt shop in Phoenix, you better be dealing with the guy that sold a lot of yogurt shops.
That's right. He's got the buyers and all the insight.
Right.
Yeah. And he'll likely be able to make a strategic introduction, right? Where there's a strategic acquisition in that scenario, they're likely to pay more than your valuation may be because there's a specific reason that they want that business.
That's right. A roll up, for example.
Yeah. You want to grow through acquisition, you bet.
Right.
So let me just say one more thing real quick. A common question for us is, how do we know the biz equity tool is accurate? And I've already said that I'm highly confident in saying that our estimate will fall within the range of what 5 appraisers would produce 95% of the time. There are always outliers, exceptions, unique transactions, and even unique industries. But generally speaking, that's true. And I think the best evidence of this accuracy is found in the fact that, number one, every one of our major customers who are literally commonly known companies, I'm just going to read a list real quick. Wall Street Journal, KPMG, Vistage, Morgan Stanley, TD Bank, UBS, PayPal, Experian, Equifax, Mass Mutual, Hightower, Northwestern Mutual, Guardian, Equitable. Every one of those companies went through a comprehensive due diligence review of our tool and our website and our reports, compared them to their valuations, however they did it, and chose to become customers.
Wow.
And even further, our average retention rate is close to 90%.
That's quite a statement to your quality. Yeah.
Yeah. And But that's all said, based on understanding that there is no such thing as devalue, and it's an opinion, and there's going to be variation.
Right. The business owners that we talk with typically won't get a valuation or won't even thinking about doing it until they're actually thinking about selling. So I want to ask you, how often should a business owner have their business assessed and valued?
Yeah.
And what's the value? I mean, if
Yeah.
you're 3 years out, is it something that you should do?
Well, in my opinion, obviously, as a business appraiser, I would say, if I owned a business, I would at least want an annual assessment, if not biannual, all within the context of learning about what are the factors that drive business valuation, and what can we do now to make the company better and more valuable in the future. So as a proactive tool for understanding what drives value, the more the better. And that's part of the appeal of biz equity, in that you have regular routine access, if you either have your own subscription or if you're working with a wealth advisor.
Mm-hmm.
So, the more the better. But obviously, if you were to pay for a full and formal appraisal every year, absent an actual reason or need for that appraisal, that could become quite costly.
Right.
And again, that's part of the biz equity appeal. It's a dramatically lower price point.
Mm-hmm. Right. So do you want to go into maybe tell us how the software streamlines and enhances the evaluation process?
Yeah, I don't think we looked at this slide from early in the presentation. Okay. That presents the biz equity tool. And I promise we'll get there.
Okay, no worries.
Here's the just a brief overview of the 7-step tool. So basically, in as little as 30 minutes, if you're comfortable with reading a tax return or financial statements, you can work through the 7-step tool and generate this 29-page report that has 4 different estimates of value, 12 KPIs, and if you want, insurance estimates, like coverage amounts that would be desirable for a certain reason.
Like key man, et cetera, buyouts.
Yeah, exactly. But in general, those 7 steps will elicit responses that include what industry is the company in, what were the revenues, pre-tax profits, owner compensation, non-cash expenses like depreciation, interest expense, any one-time, non-recurring, unusual revenues, expenses, gains, or losses, and then the balance sheet, all the assets, all the liabilities, and then a series of what we call sliders, which drive towards some of the finer points of valuation, such as customer concentration, recurring revenue, the importance of the owner. And literally, as all these different entries are made, the actual final multiple that is used is going up and down. And then finally, you get to step 7, which addresses real estate. So we have augmented the tool to allow for a clean and accurate separation and assessment of the business value versus the real estate value. And it comes down to two common scenarios where the business owns the real estate that they're operating in, and that real estate is on the balance sheet of the company. But probably even more likely, the business is paying a rent to a second entity same owners, a related entity, at, above, or below market level. And our seventh step will ask all the questions necessary to make sure that a fair market level rent burden is included in the assessment of the business value, so that you don't overvalue one versus the other. And then the real estate value is included. We've just introduced an owner compensation worksheet because of the fact that that's probably the area that we get the most questions in. People have their own point of view or predispositions as to what should be included in owner compensation, but it is truly something very specific and definitional that revolves around the concept that Eric mentioned earlier called discretionary earnings.
Right.
We want to generate the pool of cash flow that would be available to a hypothetical buyer,
right,
who steps in and replaces the primary owner and operates the business henceforth. But sometimes there are multiple owners, or that single owner might be passive, or there might be family members. And family members can be paid a lot but do nothing, or get paid nothing and they're doing a lot.
Right. It's
and in all these cases, multiple owners, family members, you need to assess what they're actually paid versus what it would cost to replace their efforts. And this new worksheet does that step by step, and is intended to just clean up that entry, because for many owner-operated businesses, the owner compensation pool can be as big as the pre-tax profits. Now, obviously, the larger the business, the less important that is, but it's still important to get the most accurate assessment of what cash flow is available to a hypothetical buyer.
Yeah.
So
I've assessed at least 1,000 different small businesses for valuation for the acquisition, or to help somebody create the value or whatever. And I will tell you that is by far and away one of the hardest parts, is determining, okay, is this actual seller's discretionary earnings, or is it, it's an actual function of the business and need and expense of the business. And, just going through the line items on a P&L and kind of pulling out, okay, certainly earnings is an easy one, but what about the insurance policy? What about the vehicle, the company vehicle? It's like,
you have to ask.
Yeah.
You have to ask.
Yeah.
You can't always glean the correct numbers just by reading the P&Ls. And that's why we've developed a complete but fairly brief questionnaire, which asks every single question that's needed to populate the tool accurately.
Yeah.
But yeah, that's a great point.
That's awesome.
I was going to ask you about other factors that investors look for when it comes to valuation, but I'm going to let Eric kind of chime in on this first, because we know that there are many other factors besides just the valuation. There can be management issues. Is the management in place, or systems in place? How's the transition going to be? Maybe Eric, you can kind of address that.
Yeah, I would say with the Main Street transactions, what we often run into is, I've got some feedback from a broker here in the Valley that took some time to really help educate me on some of the valuation tools, or not tools, but solutions, that you look through. And he kind of narrowed it down to 4 key things that they looked at. But what, basically, you mentioned early on, one of the big problems, and actually Jim references as well, is the finances, right? How are the finances being done? Are they being audited, right? That's a whole nother one. Generally speaking, most finances aren't very good in a lot of these small Main Street businesses, or when I say not good, they're not done well, right? They're not managed well. There's a lot of extrapolation, a lot of different things that are
question marks.
Yeah, exactly. But then you also have, you referenced it a minute ago, but how engaged is the business owner, right? And what role does a business owner play? Or, do you have somebody who actually runs the day-to-day in the business owners? It's like when I look in a business, I'm looking for somebody who says they have a passive business. And then I start checking the boxes, and I'm like, okay, how much time do you actually spend in the business? Because that helps me determine whether or not it really is what I would consider an investable opportunity versus I'm buying a job, right? And that's where we run into with a lot of our business owners.
Yeah. If they tell you it's 70 hours a week, you know that it might not be a good candidate.
Or it could be 100 hours.
Yeah,
right,
yeah, exactly.
Like most
Depends on the week.
entrepreneurs realize that right away, that it's a much harder task to run your own business than it is to be an employee in some cases. So I know that a lot of advisors out there use your tool, Scott. Maybe you can address a little bit about the people that could use this to help enhance their business with prospecting and their businesses.
Sure. I think it's literally the perfect tool for any advisor that wants to ingratiate themselves with their business owning clients, become more important to their day-to-day operations, and therefore more necessary going forward. But our client base is essentially comprised of, and in this order, I would say, wealth advisors, insurance agents, commercial bankers, business brokers, CPAs,
coaches like us,
business coaches, exit planners, and then of course just business owners.
So is the tool hard to learn, or do you guys have a pretty comprehensive training program?
We have an exceptional customer service department, and basically any question that you may have, most likely we've come across it before, unless it is related to some new implementations inside the tool. And there's a lot of those that are happening now that are quite interesting and helpful for clients. But there's an onboarding process. We have a customer success center online that has everything from how to go about using the prospecting database to what are discretionary earnings.
Okay.
So
it's comprehensive, and
the website, there's a lot of good resources.
Good.
At the ready.
Okay. Well, we're running over time here, so I just wanted to ask you: is there anything else that you'd like to share about your company? You've really created a very nice opportunity for people to use, and the tool looks wonderful.
Yeah. Well, thank you, and I apologize for talking so much.
That's okay.
Scott, I was going to say, I just saw you pull that up, and I was looking ahead there, and I'd like to get a couple of insights here on the the SBA program. Some of the changes.
Yes, crazy changes, unprecedented changes to a magnitude unlike ever seen before. I was actually involved in 2007, 8, and 9 in writing the business valuation requirements for the SOP 50-10 policy book for 7A and 504 loans.
Wow.
So I know kind of what the history has been in terms of all of the requirements in the SOP 5010, and the changes that were made this time are literally off the charts. Personal liquidity rules have been removed. Sellers can remain as a key employee. The determination of business affiliation has been increased, making it easier for bigger companies, basically, to be using the guaranteed loans. And other changes as well, such as the moratorium on new small business lending companies was rescinded. That is going to open the door to algorithm-based lending, fintech companies, basically. And I'll let the viewer read these other things, but the one that I wanted to focus on was this change, which is very interesting. For the first time ever, you can now use an SBA loan to buy or sell a 10% stake in a company.
Wow.
Yes.
An individual investor even.
That's it.
Huh.
Historically, it was, it was all or nothing, 100% or nothing.
Right.
And so it obviously is raising a lot of questions. And in general, the Congress is kind of pushing back on a lot of the changes. I haven't checked on any recent developments, but what this means from a valuation point of view is that you have to go beyond just looking at the 100% control value to consider what the impact of discounts would be, specifically discounts for lack of control,
Right.
discounts for lack of marketability. So in general, as you know, a 10% interest in $1 million company is not $100,000 in most cases. It's worth something less than that because that interest is non-controlling and it's non-marketable. Mm-hmm. So especially in the world of estate and gift tax purposes, when you gift a 10% interest, these discounts have to be derived and applied. And completely coincidentally, we had already begun to build a module for the Biz Equity tool that will calculate the discounts for a minority interest. So it's almost ready to go on because we started, like 6 months ago, several months ahead of this announcement. But
the net of this discussion on this topic is that the Biz Equity valuation is acceptable to most bankers for getting involved in the SBA process.
Well, let me be crystal clear on that. It's helpful and useful if the loan amount is under $500,000.
Okay.
Generally speaking, if it's more than $500,000, however, a qualified appraisal is required.
Got to spend the money.
Yeah. And a qualified appraisal is one done by a certified party with experience, directly hired by the bank. So we've tried to crack that nut unsuccessfully, but who knows? I mean, they're allowing fintech companies in, but as of now, unless the loan was under $500,000, you would still need a full and formal appraisal.
Gotcha. Well, Scott, this has been a wonderful presentation. We really enjoy you being here today, and we're very happy to have had you. If somebody wants to learn more, they go to your website, bizequity.com, and can they reach you directly if they need to?
Of course. Anytime at sgabehart@bizequity.com.
Okay.
And we'll make sure those are in the show notes.
Yeah.
Good.
And
okay.
And I will provide those PowerPoints and white papers for everybody to see as well. And thank you guys so much for listening to me ramble on. I also enjoyed it very much.
Well, good. We're very happy that you came. Eric, do you want to kind of fill us in on what's happening with My Biz Coaches? What's going on? What's happening?
Yeah, so tonight I'm on my way to a mixer in the next hour or so, but we'll be sponsoring an event with one of our partners, Network Live here in the Phoenix Valley. So if you're local, feel free to stop by. But so this weekend we have the event we're sponsoring, and then next month we have some cool things coming up. We probably won't announce those till next week, but a little teaser there. We got some new information coming out. For those of you who've seen the new website, mybizcoaches.co, got some great new things going on over there, and got some great new partnerships that we're excited to be announcing sometime in October. So
great. Well, there's an events tab on there on that website if people want to get more details about tomorrow's presentation.
Absolutely.
Tomorrow's meeting. Okay, great.
Yep.
Well, gentlemen, I think that wraps it up. I appreciate you all being here today. It's been great. glad to have dived into this topic, and we're very happy to have discovered your company, Scott, and
Absolutely.
look forward to helping you any way that we can. So
Yeah,
that kind of wraps it up from my end. Yep.
Yeah. Thank you.
Thank you. I appreciate it so much, Scott.
Okay.
Our pleasure.
Take care.
All right.